With all its tax benefits, superannuation is a very attractive structure to build assets for your retirement. But how do you use the wealth you've accumulated in super to build a retirement income stream? That's where an account-based pension comes in. Even more tax effective than a superannuation accumulation account is an account-based pension. In fact, it is a completely legal, tax-free haven right here in Australia, available for everyone to use. The trick is to use it effectively. In this video, I will explain exactly how it works and give you some tips to maximise the benefit in the lead up to retirement. An account-based pension is the retirement phase of superannuation. It is a pension account that holds assets to produce an income stream for your retirement. As the owner of the account, you have flexibility over what assets your pension is invested in. You also have flexibility over how much income you draw from the account, more on this later, and the frequency of the repayments. The idea is that when you decide to retire, turning off your earned income, an account-based pension can be a replacement source of income to meet your living expenses. How long your money will last will depend on a few key factors, including the starting balance, how your investments perform, how much you withdraw each year, and if you take lump sum payments. There's no lifetime guarantee, but the tax advantages can make your money go further than non-super savings. When taking a pension, the government sets a minimum amount you must withdraw each year based on your age. The older you are, the higher the percentage you must take out. This table summarises the pension minimum applicable to each age group. As you can see, it starts at 4% for those under 65 and goes all the way up to 14% when you're over 95. If you start partway through the financial year, you only need to withdraw a proportionate amount. There's also no maximum cap unless you're in a transition to a retirement pension, which limits you to 10% of the account balance each year. One of the biggest perks of an account-based pension is the tax treatment. If you're 60 or older, any income you withdraw is completely tax-free. It is classified as non-assessable, non-exempt income, and therefore there is no need to report it on your tax return. And it's not just about the income payments. Investment earnings within the account, whether derived from dividends, interest, or capital gains, are also tax-free. That means more of your money stays working for you instead of getting eaten up by taxes. If you're investing in Australian shares, which provide a franked dividend, the franking credits are 100% rebated back into your account because of the tax-free status. This adds to extra income to help fund your retirement. If you're using a TTR pension, it's a bit different. Your investment earnings are taxed at a rate of 15%, similar to an accumulation account. But once you've fully retired, it's back to the tax-free haven. In order to commence an account-based pension, you must meet the eligibility criteria. This depends on your preservation age and working status. Your preservation age is the age at which you can start accessing your superannuation. If you were born after 1 July 1964, your preservation age is age 60. The amount of superannuation you can access will depend on your working status. If you're between ages 60 to 65 and still working, you'll have partial access to superannuation through a TTR pension. The maximum you can draw down is 10%. If you're between ages 60 to 65 and not working, you'll have full access to superannuation and a full account-based pension. If you're above age 65, you'll have full access to superannuation and an account-based pension regardless of your working status. Even if you do not currently meet the eligibility criteria to commence an account-based pension, you should be planning for it now. This includes utilising contribution cap limits to maximise the amount you have inside superannuation for an eventual account-based pension and ensuring you're in an appropriate superannuation fund. When it comes to choosing a super fund, you should choose a fund which offers a seamless asset transfer. This means you can transition the assets you hold in accumulation phase into pension phase without triggering a capital gains tax event. The benefit of a seamless asset transfer is that it allows you to accumulate significant capital gains on invested assets throughout your working life and pay $0 in tax by selling them down in pension phase. This is a very powerful strategy. The next best thing is a retirement bonus under a pooled superannuation arrangement. This is a lump sum payment to account for some of the tax savings when moving into an account-based pension. Retirement bonuses are applicable to pooled superannuation arrangements like industry super funds, but only a handful of funds actually offer the benefit. It's important to note that there is a limit on how much you can put into a retirement phase pension. This is called the transfer balance cap, and it's currently set at 1.9 million in the 2024-25 financial year. Any amount above this has to stay in accumulation phase, where investment earnings are taxed at 15%. If you've already started a pension before 1 July 2024, your transfer balance cap might be between 1.6 million and 1.9 million, depending on your individual circumstances. An account-based pension is a fantastic way to get the most out of your super during retirement. It offers flexibility, attractive tax treatment, and the ability to tailor your income to your needs. We start preparing our clients for the effective use of an account-based pension from phase 1 by looking for an appropriate platform to house clients' super. We then deploy strategies through phases 2 and 3 of wealth creation to maximise the benefits before kicking off an account-based pension in phase 4. If you're not using your superannuation wisely, I can almost guarantee that you are paying too much in tax. If you think an account-based pension is an appropriate strategy for you, we strongly recommend you speak with your financial advisor. They can help assess the appropriateness for your particular situation. Please note, the information contained here is general in nature only and does not take into consideration your objectives, financial situation, or needs. As legislation is constantly changing, the accuracy of this information is only current as at the time of recording. Before relying on the information, you should check to see if the content is still relevant.